crossed $100 a barrel overnight. The dollar hit a 3.5-month high this morning. And silver, which just recorded its worst 3-week decline in years, reversed course in a single session and jumped 3.6%. These three things are not separate news items. They are three readings from the same instrument. And right now, that instrument is pointing somewhere very specific. Here is what is happening. In the week ending March 20th, 2026, silver futures fell more than 14%. It was the third consecutive losing week. It was the worst weekly performance the metal had recorded since before most retail investors began paying attention to precious metals. Headlines called it a rout. Analysts on financial television described it as a breakdown. And then, on March 26th, silver climbed back to $72.11 per ounce in a single session. A 3.6% rebound. One day, no warning, no fanfare. That kind of move does not happen in a dead market. That kind of move happens in a market that is under enormous tension, pulled in two directions simultaneously by forces that have not yet resolved. Understanding which force wins from here is the only analysis that matters right now. Start with the dollar. The dollar index today is trading at a 3.5-month high. In conventional precious metals analysis, a strong dollar is bearish for silver. The reasoning is simple. Silver is priced in dollars. When the dollar strengthens, silver becomes more expensive for buyers in every other currency. Demand softens, prices fall. That logic is correct as far as it goes. The problem is that it does not go far enough. The dollar is not strong right now because the American economy is strong. The dollar is strong because the world is afraid. The war in Iran shows no signs of easing. Brent crude has crossed $103 per barrel. When geopolitical fear spikes, capital moves into the dollar as a reflex. It is the deepest liquidity pool on Earth. But that reflex is mechanical, not fundamental. And mechanical moves have a ceiling. Here is the tension at the center of this market. On one side, a strong dollar and elevated bond yields are suppressing silver through the conventional channel. On the other side, the very conditions creating that dollar strength, a war in a major oil-producing region, crude above $100, supply chain stress cascading across multiple continents, are also building the inflationary pressure that historically destroys the real value of that same dollar. These two forces cannot coexist indefinitely. One of them resolves first. And the history of every major precious metals cycle says the same thing about which one it is. Christopher Lewis, senior analyst at FX Empire, noted this week that silver is currently in a highly volatile phase, searching for a new equilibrium point. He pointed to Middle East tensions and the trend of elevated U.S. interest rates as the two primary pressures bearing down on the metal. What Lewis also acknowledged is that the recovery will depend on geopolitical developments. That framing is important, because it means the catalyst for silver's next move is not a Federal Reserve announcement. It is not a jobs report. It is a conflict that no central bank controls and no algorithm predicted. Pull back further, and the picture becomes even clearer. Silver peaked at $116.61 per ounce on January 28, 2026. By February 5th, it had fallen to $70.90. That was a 39% decline in 8 days. One of the steepest single moves in the metal's modern history. The kind of move that wipes out leveraged positions and shakes out every investor who does not truly understand what they own. And then silver did something that casual observers missed entirely. It held. It did not break down to 50. It did not collapse toward 40. It found a floor in the low 70s, and it has been building a base there ever since. The metal that just absorbed a near 40% correction in 8 days, followed by 3 consecutive losing weeks, is now trading at $73 per ounce and just posted its biggest single-session gain in weeks. That is not behavior consistent with a market in structural decline. That is behavior consistent with a market absorbing maximum pressure and refusing to break. The industrial demand picture has not changed. Silver's role in solar energy production, in electric vehicle manufacturing, in advanced electronics, does not pause because a futures contract sells off. The physical market does not care about paper volatility. In India, the world's largest consumer of physical silver, Domestic prices just reversed a 10-day losing streak with a 15,000 rupee per kilogram jump in a single session. That is not a paper market reaction. That is real buyers returning to the market at a level they consider acceptable. Now consider what the oil price above $100 actually means for the inflation trajectory. Energy is the input cost for nearly every manufactured good on Earth. When crude crosses that threshold, the effects do not appear in the inflation data immediately. They appear 3 to 6 months later, embedded in freight costs, in manufacturing margins, in the price of everything that moves from one place to another. The Federal Reserve is not currently pricing a rate hike at its next meeting with more than 8% probability according to CME Fed Watch data. Inflation at 3.5% with rates at the same level means real interest rates near zero. Now introduce oil at $103 into that equation. The math does not improve for the dollar, it deteriorates. And deteriorating real interest rates are the single most consistent historical driver of precious metals outperformance ever recorded. Silver has now gained more than $38 per ounce over the past 12 months. It has survived its biggest one-day crash since the 1980s. It has absorbed a war-driven dollar surge, a 3-week institutional sell-off, and 14% weekly declines without breaking its long-term structure. Every major correction in this cycle has ended with the metal finding support and rebuilding. The pattern is not new. The pattern is not complicated. The people who sold silver during the correction called it a breakdown. The people who studied the structure called it something else entirely. They called it an entry.